I'd like to welcome all those logging on to Money Show's Virtual Expo. Thank you so much for being here. We have just under 4 minutes before the start of the next session. So sit back. We'll be back momentarily with Natalie Pace. Thank you so much for being here. All right, Natalie, we're about a minute and a half out. I'm going to stop share on my side here. If you want to go ahead and just load up that PowerPoint, we'll make sure everything looks good. All right, slides look great. And I'll lead us off with a quick intro coming up, and we'll be all set. All right, everyone, welcome back to Money Show's Virtual Expo, your 2026 portfolio review. We are pleased to welcome our next presenter, Natalie Pace. Natalie is the co-creator of the Earth Gratitude Project and the author of the Amazon bestsellers The Power of 8 Billion, It's Up to Us, The ABCs of Money, 6th edition, and more. She's been ranked as a #1 stock picker above over 835 A-list pundits by the independent tracking agency Tips for Traders. Natalie's easy as pie chart, nest egg strategies are enthusiastically recommended by Nobel Prize winning economist Gary S. Becker, former TD Ameritrade chairman and CEO Joe Muglia, and over 120,000 people who have transformed their lives and relationship with investing and money as a result of attending her retreats and reading her books. Natalie, always a pleasure speaking with you. It's all yours.
Thank you so much. And thank you guys for joining me today. I'm going to get started right away. We've got a lot to go through, but the whole goal here is to, one, tell you what we were doing for 2025, which honestly, we're hot, hot, hot. And B, say, hey, can we still do this in 2026? What are the risks? How do you diversify properly? Should you be capturing gains? And all this and much, much more. So let's jump in for your 2026 playbook. So we're feeling pretty hot because two of the actually only I haven't been doing a lot of independent stock picking because I felt that in this current environment where equities are so overvalued, most people get into trouble. However, I did pick three last year. I picked First Majestic Silver, McEwen Mining. We actually featured an interview with Rob McEwen, and also Archer Aviation, which I think still has room to grow. So two out of those three were spectacular. So our First Majestic Silver is up 378% on the year, year over year. McEwen Mining 237%. Peru ETF is a value replacement for mid-cap value replacement. There are reasons that we're doing value replacement funds. That one doubled. And it's really interesting because we hear so much about the Magnificent Seven, and this is the performance chart showing you, hey, the Magnificent Seven is still magnificent when you compare it to the S&P 500, and really magnificent when you compare it to the Dow Jones Industrial Average. However, having heat in your portfolio, and you don't have to have the individual companies. You could have picked silver, that's almost tripled. Copper doubled. And again, this is even above gold. So gold and Magnificent Seven have been making headlines, but these are, silver is a superstar, and our Peruvian fund, which is a play on copper, is really a superstar as well. But equally important, we have been underweighting US value funds. And that means that some of the worst performers are the ones that we're underweighting. We're actually looking for country diversification instead of that. And that's been playing off big time. Again, Peru is just one of our value replacement funds. So again, here's Silver Majestic. I just want to remind people that, investing in individual companies is just not right for everybody because it is risky to try to buy and hold. We do have too much of a roller coaster. The forward outlook for it in December is still great. The next earnings report is predicted to be pretty strong. Thereafter, the first quarter, even if it continues apace, and it can, it's still going to start lapping its results when they were really strong. So it's not going to be as spectacular. But, in the last quarter, the year-over-year revenue growth for First Majestic was 94%. And it's probably going to be pretty close to that again. Certainly could be easily above 70%. So again, if you would like to access my interview with Rob McEwen, just email us, info@nataliepace.com, or you can go to YouTube, my YouTube channel or my Substack channel, and access it there. But it's a pretty important interview because not only does he talk about, obviously, his gold and silver, but also he has a very large project called McEwen Copper that's located in Argentina. They are planning an IPO this year, so it's a good idea to check out that interview and see what he has to say about McEwen Copper and McEwen Mining. So again, will these precious metals continue to soar? Could anything ruin the party? I would say that, whenever we hear headlines like Sell America or, any of these things, there's just a lot of turmoil in the world. If stocks out south, people are looking for a safe haven. And we, in the past, had a lot more competition from Bitcoin than we do right now. I think people are a little bit more concerned about Bitcoin, and we're going to go into why that is the case going forward. For 2026, it still has a good outlook, beyond that, but we could have another crypto winter, actually in 2026, something else we'll talk about. So, Goldman Sachs has said that gold is their favorite precious metal minus silver, and that preference has really paid off. And then, of course, copper, we're going to start looking at as well. That's a little bit different because that one's more of an industrial metal. And obviously, the precious metals are more of a play on when people are worried about the dollar or worried about stocks. But I do want to remind you that in the beginning of a stock downturn, safe havens can sink. This is a chart from April. And, we saw that it pulled down SLV, that Silver Trust ETF. It pulled it down almost in tandem, but then they will decouple at some point. So let's jump into copper. And that is, we were leaning into copper through our Peruvian ETF. The symbol is EPU. And this Peru is the second largest copper producer in the world. It's behind Chile, and it is our small mid-cap value replacement fund. So why did we choose Peru instead of Chile? Well, you can't really benefit from the Chilean copper mines because they're nationalized. So we also have seen much higher GDP growth in Peru versus Chile, probably as a result of that. Now, a lot of people were saying, there is socialist happening. And in fact, this can hit individual copper mines, right? And it has. So if you're investing in a certain individual copper mine, they may have had their production shut down for a couple of months, and that's going to be a bigger challenge. So again, investing in Peru has been our preferred choice rather than an individual company. And the reason for that is that the economy is so tied to copper. And with copper prices high, everybody has the incentive to try to figure it out and figure out how they can calm, the strikes and the things that unrest that's happening because this is their economy and they can really benefit from high copper prices if they can figure it out. Now, will copper prices go higher? There is still, and some of it has to do with not just the social unrest in Peru, with other places as well. Supply is still a bit constrained and demand is soaring. This has to do with electric vehicles and a lot of other things, but copper has been called the new oil by Goldman Sachs. So it's not expected to soar, but it is expected to go higher in 2026. And that's as a result of, again, constrained supply and really massive demand. So, why is it called Dr. Copper? And this is important to realize, right? So, if we hit an economy that really slows down, people aren't going to buy as many electric vehicles. Now, we are still expecting 12.5% increase in electric vehicle sales worldwide in 2026. So, this isn't predicted, but economists are pretty lousy at predicting recessions. So, it's important to understand that even something that's super hot and the wind is at your back, everything looks great, there still can be some risk to it. And we'll talk a little bit more about how we manage that risk, but the main reason or the main way we do it is having an age appropriate, properly diversified plan that we rebalance at least once a year. So you can capture gains and you can still have game on. So if it keep going up, you're still profiting from that. So we're actually using value replacement funds for instead of US funds. There are many reasons for that. And part of that is that in the United States, I'm going to show you in the chart, over half of the S&P 500 is at or near junk bond status, and that includes a lot of banks. So we can go to other countries, and sometimes they'll have even a higher sovereign rating. Sometimes they'll have higher bank ratings. And oftentimes you're even getting a higher yield. In fact, even the Peruvian fund was offering a great yield. Of course, then it exploded and doubled in share price. So the yield is still like 1.31. It's still pretty decent. But so in some cases in our value replacement funds, we're actually getting less risk and more reward. And that's just, something we're doing because of the amount of debt that's going on in the United States right now that tends to be more concentrated in the value funds, in the growth funds, in companies like the Magnificent Seven. A lot of them have treasure trove of cash and very low debt to equity ratio, whereas a lot of the other the ones that were performing the worst on that performance chart I showed you, which is why we're underweighting the value side, a lot of those are the ones that have the very high debt equity ratio. A lot of their cash is going towards paying off debt. Even their product decisions, we just saw that Ford pulled back even more from electric vehicles, and that has a lot to do with the fact that they have to convince their shareholders that they're paying off their debt because they have a BBB minus credit rating with a negative outlook. So we're underweighting value in the US, and those are just some of the reasons why. Also, I just want to remind people that if you have, a lot of you guys are accredited investors, you're paying, anywhere from a half to 1.5% to have your money managed. And I'm seeing a lot of people that are paying literally thousands of dollars to lose money or to have paper losses. And those paper losses are far more problematic than many people understand. Also, you might be an accredited investor that has a lot of money in a 401(k) and a target date retirement fund, and or your only choice is a bond fund for your safe side, or one of the few choices that you have. So I just want to, let you guys know that we're still having a lot of problems on the bond side. And even on those target date retirement funds, look at the performance of this one, a 2030 fund compared to that's just the S&P 500. It's not even one of our hots. So again, paper losses, they can become real. And we have been very, very happy to report that over the last, gosh, since we've been, doing this, really, we've been calling it right. So in after the Great Recession, you weren't being paid to take on the risk. You were earning nothing if it was an investment grade bond, and if you wanted to earn anything at all, you had to go into junk. And so we were at that time in the early stages, real estate was low. We just said, hey, why don't you invest in real estate and get a yield by renting it out? And that was a better choice. Obviously, real estate doubled, it was on fire. Now we do have a strategy for bonds, but it's really tricky. It's not hard, it's just tricky. So I did just do a bond masterclass. And obviously that's not the focus of today's thing, but I think it's very important because if you're over the age of 50, half of your assets should be in fixed income. And if the fixed income side is producing paper losses, it's not being made up by the yield and those paper losses. A lot of people say, "Oh, well, I just hold a term." And I said, "Have you looked at the date that they're supposed to pay you back? I mean, 50 years from now, are you really willing to hold it for term and have your FICO score low and the paper losses still registering and your wealth obviously going down?" So in general, the higher the dividend, the higher the risk. On the equity side, we're using value replacement funds. We're getting country diversification. And on the fixed income side, we're keeping the term short and the credit worthiness high. And again, I did just do that bond masterclass. And if anybody would like to register for my spring retreat, just ask for the bond masterclass. We'll give that to you as our free gift for registering for the retreat. So happy to do that. And this is the asset bubble chart. So we hear a lot about the $38.5 trillion in public debt. What we don't hear a lot about is the total debt and loans is actually $106 trillion. Many people just aren't aware of that. So I just think it's important. If you would like access to this asset bubble chart, email info@nataliepace.com and just ask for it. We'll send it to you. Now, I'm going to try to cover a little bit more ground here, but look, anything can happen, right? If people could go crazy and they'd say, "Oh, I'm so worried about stocks. I'm so worried about the dollar. I'm going to invest in crypto," and then it could soar again. That could definitely happen. But what we definitely have seen is that there is a high correlation in this kind of what I call the halving event cycle. And what happens, the last halving event was April of 2024. What we do see is that the following year is when the Bitcoin hits its high, and a lot of the currency follows Bitcoin. Um, and then the next year, the second year after the halving event, which would be April of 2026, that's when we see these crypto winters. It's just one historical trend, and obviously the future doesn't have to look like the past, but it often rhymes. And we have been telling people about that and encouraging them in April of last year, okay, be sure you're taking your profits and trimming back, or if you're trying to get in here, dollar cost average, because you don't want to just buy high and lose if we do hit a crypto winter. So this is just a reminder of the performance in 2022, and also a reminder for those of you that are really infatuated with Magnificent Seven, that the Magnificent Seven is what drags down the S&P 500 and now the Dow, that so many of them are there as well. When we hit hard times, it's not because they're not magnificent, they are. It's that they're overvalued. All that magnificent is already priced in. So whenever there's any kind of spook in the market, those are the ones that farthest the fastest, dragging down the S&P. It was something we saw in April of 2025 when it was the tariff scare, and it's something we saw absolutely in 2022 as well. And that was, when the S&P 500 went down 20%, or almost 20%. The NASDAQ dropped 33%. That's where, there's a greater concentration. And then, of course, Tesla was down, and ARK Innovation Fund. Both of those were down by 2/3, right? 67%, as was Bitcoin. So that is another, again, what do we do to manage that risk? You definitely want large cap growth. In fact, we like growth in mids and we like growth in small caps too. But you want to capture gains. You don't want to just buy and hold and ride this roller coaster. So always make sure that you have an age appropriate, properly diversified plan in place, and that means rebalance it at least once a year. So, is there going to be an EV winter in 2026? Not really, in that it's still supposed to grow in terms of sales, whereas the internal combustion engine, sales are actually going down, and some people believe that it's in terminal decline. But it's important to know that, look, Tesla's going to report their earnings tomorrow after the markets close. Their deliveries were down 16% in the fourth quarter. They are probably going to have less than $5 billion in their net profits. And that's versus 15 billion in 2023. Their market cap, sorry for that misspelling there, is 1.5 trillion, and they may only have 5 billion in net profit. Their PE is pretty outlandish, 302. So just be cautious. And that's an example of what I'm talking about. These are very popular companies. They are selling a lot. Part of the reason that Tesla's net profits are down is that the biggest EV market is China, and China has a lot of EV manufacturers that compete with Tesla. And even Tesla has had to lower their prices, and obviously that has impacted the profits as well. Yes, I know Tesla has other things going on, including their AI and their solar and all of that. But I think that we also have to look at the fundamentals a little bit here. So I just want to remind you that some of the risks out there are that, the VIX is low, but that can change in a snap, and consumer sentiment is a big concern. We have a K-shaped economy. This is something from Moody Analytics and Mark Zandi, their chief economist. We've seen an escalation in distress in a lot of lower and middle income households. This is the delinquency rate of various types of debt. All household debt is that dotted line. Student loans are now again a problem. And another risk in the market is the expensive equities. So as you can see, you want to look at the blue line. This is the CAPE ratio from Robert Shiller, Nobel Prize winning economist. And the only time in history, dating back to the 1880s, when stocks were more expensive than today was the dot-com recession. It's even more expensive than the Great Depression in 1929. And just as a reminder, the NASDAQ fell 78% in the dot-com recession from the high to the low, and it took 16 years to get back to the high. So that's a long period of time. Again, that's just overvalued. Now, people might say, oh, well, AI isn't going to pop like .com. It's not that AI or .com wasn't going to be the future. It's a Peter Schumter, he's an economist. It's more his principle. In the first bit, everybody rushes at it and it gets into this bubble, and the bubble pops, and there's a lot of companies that don't survive it. Obviously, NVIDIA will. And then those companies, but they lose value as well. And then those companies go on to make it cheaper, and then it is adopted by everybody again. Nobody really stopped using .com, even when the .com crashed. We were still pushing forward the technology from the user standpoint as well as from the people that were producing it. So that's what's important is to know as an investor in that these creative destructions that happen very, very naturally as part of, evolution of business, that they do have two cycles. They do have a boom and bust cycle, and that affects investors. It wipes out some of the companies. So it's just again another case for not betting everything on stocks always just going up. Also, election year trends are that midterm years do tend to perform pretty poorly in the cycle. Again, this year and last year as well, AI has really pushed up GDP expectations. So there isn't a recession predicted, and it's got a lot to do with AI. But we also saw a tariff scare that made stocks drop 20% in less than a month in April of 2025. And that's what can happen when things are expensive, is that we might not hit a recession, but we could actually have a correction just because of the expensive nature of the stocks. So again, we just encourage an age-appropriate, properly diversified plan. If you wish, you can overweight safe if you think equities are super expensive and that there are more risks for a downturn. That just helps you to limit any losses if stocks head south. This is for a 50-year-old that's overweighting 20% safe. And again, a time-proven 21st century plan. That's why Gary Becker endorses it, is that, if you are always acting your age, if you're capturing gains at least once a year, and keeping enough safe, then, this is a plan that's time-proven. It actually earned gains in the .com and the Great Recession and has outperformed the bull markets in between. And it wasn't like any of my stock picks attached to it. It was just 10 funds rebalance once a year and know what's safe. And that's a key side of it, right? Because this time around, it's going to be a little bit different on the safe side. Also, if you are interested in any of the things that I featured that were so hot, 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 maybe you don't just buy them high, but dollar cost average into them so that if stocks do head south, you're buying more at a lower price. And again, 1 to 3 times a year rebalancing is very important. Now is a great time because stocks are at an all-time high, so you'd be capturing gains. You can do that a couple of ways. I do unbiased second opinion through my private coaching. Just email info@nataliepace.com. Doesn't hurt to know what you own, right? And then you can make choices. If you have blind faith that somebody else is doing it for you, you might say, oh, well, they're doing a great job. Well, of course, but don't confuse a bull market with wisdom, right? It's not hard to make money in a bull market. It's actually hard not to lose money if we actually hit a correction. And that's why you want to make sure you have an age appropriate, properly diversified plan. And if you do have paper losses, I would take it as my invitation that I do need to know more about what I own and how to get safe without having paper losses and earn income without paper losses. So again, you can also personalize your own sample pie chart with our free web apps. So email info@nataliepace.com and just have in the subject line that you want your free web app. Also, we have, blogs, video conferences, retreats, etc. You don't want to miss them. I do them at least once a month. And this is our next retreat. If you register by January 31st, which is Saturday, you also can receive one free coaching session. So I'm happy to take any questions you guys might have. Do we have any questions?
All right, Natalie, thank you so much. We do. One question that came in, it said, this is a midterms year. Is it going to be like 2018 and 2022 when the S&P 500 is down for the year?
Yeah, and I think that, look, I think the important thing to always remember is that in the short run, the stock market is driven by sentiment. And then in the long run, it is driven by the fundamentals. So people are very excited about AI. And the one risk there, right? So that's what's been driving things forward. You see, these outlandish valuations for anything AI. But that's what's been driving the markets forward so much. And honestly, I think people are still very excited about AI. And there are a lot of people who invest in it who don't know just how overvalued the markets are, right? So in the short run, the investor sentiment could continue to run. Also, uh, the big risk and the thing that people talk about when they talk about the AI bubble is not just that it's so overvalued. It's also, are they going to be able to monetize? So we are, and by the way, that's the same thing in the .com, right? Like you saw companies like Amazon that survived .com, and you saw I'll deliver your pizza for free.com that went belly up. Even eToys went belly up. So what happens is that it's a cash burn industry right now. The other companies are selling other things, or I mean, obviously NVIDIA is the leader, and a lot of the product that they're selling is AI product. But companies like Google, companies like Apple, companies like Meta, these are all companies that are leading in AI as well, even Tesla. And they're making their money in other verticals. So what I would say is that there's no guarantee that we're going to have an up year, although the analysts are predicting another 16% rise in the S&P 500. I just looked at this from, thank you, Howard Silverblatt, the senior index analyst of S&P Dow Jones Industries. So they are predicting a rise of 16% in the S&P. That's the prediction, right? But again, analysts and economists never predict recessions. Those always come unexpectedly, right? Or even the tariff scare. So I think that your best choice is act your age, make sure that you have enough safe, you know what's safe. And if you are concerned that that the midterm year will be more like 2022 or 2018, 2018 wasn't as bad as 2022, then overweight safe. Act a little older than you are. And that way, just earn that safe income. And again, I'm seeing people who are overweighted safe that are still performing above the markets because they're including those four hot industries. Let me just show you that real quickly on our diversification pie chart that we show you guys. Here we've got four hot slices. We've got small, medium, large, value, and growth, four hots. So our silver outperformed our Peru, which was the mid-value plate replacement, doubled. The silver tripled. So we've got even clean energy was way above the Magnificent Seven. So you can really have your cake and eat it too. Is there any other questions?
A question came in here, and this is kind of going towards younger investors. How can younger investors build wealth more strategically than previous generations?
Oh, I love this question. Okay, so first of all, on your whatever your employer is willing to match, that goes into your 401k because there, again, that's free money, right? But you don't have the choices. So you can't invest in silver or Peru or any individual stocks. The second mistake I see a lot of people doing, and look, in the early stages of crypto, you had to have a crypto wallet or you had to go on, one of the crypto exchanges. You couldn't really do this. But now you can actually invest in crypto in a Roth IRA. So what I would say is this, and the third thing is look into health savings accounts because if you're young, chances are, a lot of people say, oh, my employer pays for it, but the employer usually is taking money out. You're paying a lot for it. If you can go to a high deductible, so you still have health insurance, this works only for healthy people. If you're not healthy, it's not a good idea. Then look at setting up a health savings account. So not only are you going to get it's a tax deduction. It also is going to become the best long-term healthcare plan, but you're going to save, for most people, you can save thousands or tens of thousands of dollars annually in healthcare premiums. So I would say all of the above is understand that you're not just investing in your 401k. You want a 401k, you want to max out your personal Roth IRA. That's where you're going to stick your hots. And you want to see if a health savings account is right for you. And all of this, by the way, is in my book, The ABCs of Money, sixth edition. I've covered blogs recently on health savings accounts and all of this as well. So reach out. You can always email us at info@nataliepace.com. Just tell us what blog you're interested in or what question you have.
All right, Natalie, fantastic presentation as always. Thanks so much for joining us today.
Thank you.
All right, everyone, and a big thank you to Natalie Pace. Be sure to check out the ABCs of Money and stick around. We have more content coming your way. You're watching Money Show's Virtual Expo, your 2026 portfolio review. Thank you so much for being here.